Good afternoon, everybody, and thank you so much for joining us this afternoon. This is going to be the quarterly market review, and what we're going to do during this review is to take a look back to the fourth quarter of 2015, and then of course we'll set you up for what has been already a rocky road in 2016 and look throughout the end of the year so that you will have a good understanding of what we're doing in the portfolios, what we expect going forward, and what we're seeing in the economy. So let's go ahead and get started on this. Looking at the quarterly market review, we are going to do a couple of, we're going to look at a couple of different things. First of all, we're going to be looking at the market summary. We'll look at the world stock market performance, the different asset classes throughout the world and how they're performing. We'll look at U.S. stocks, international developed stocks, as well as emerging stocks, select country performance, REITs, commodities, fixed income, and global diversification. So basically what we're trying to do in this webinar is to give you a good overview of what's happening around the world, how it may be affecting your portfolio, and why we're making the decisions that we're making. One of my clients asked me last week why I'm always such an optimist, because I was telling him about all the ways that we thought that things are going to go positive by the end of this year. And he said, you know, it's something very consistent about you that you're very optimistic at all times whenever we're talking about how things could improve. And I told him that I've always viewed myself as a financial planner very much like a doctor. And so if all of my clients have the flu at the same time, I have to believe that there's a way that I can make them healthy again. And that's what we as financial planners believe in our profession, that things are going to get better. The stock market is going to get back on track. We are going to be able to achieve goals. And something like this short-term market downturn is not something that needs to throw us off course. So one of the things that we'll be talking about throughout today is looking back at your goals and keeping your goals in mind, and even through something short-term like this particular market downturn, how can we make sure that you are on track and look at short, medium, and long-term ways that we would handle your portfolio. There are going to be three themes that you hear over and over again throughout this webinar, and they're not any different than what you're reading in the financial press or even in the mainstream press, and that is China, the Fed, and oil. So we'll talk through all of those things. One of the things I do want to mention right at the top is that we don't see two things that we have lots of questions about. We don't see a recession on the horizon, and we don't see 2008 on the horizon. 2008 was an ugly time for all of us, and so whenever there's any sort of a downturn, we are always going to start asking the question, is there going to be another 2008 around the corner? That was a black swan type of event, something that was highly unusual but was really detrimental, not only across the global financial markets, but also throughout portfolios. And so we want to make sure that in a situation like that, that is very severe and is a crisis, that we take a completely different approach to the markets and to portfolios than the one that we're going through right now. This is not a 2008 style downturn. 2008, we saw lots of correlation between stocks and bonds. Virtually all asset classes lost money during that time period. And we had really a fundamental misunderstanding in the financial markets about how much anything was worth. Nobody felt like they could value anything, and so everything lost value. What we have right now is a temporary downturn. We have very strong fundamentals in the domestic economy, and I'll be talking about that in a little bit as well. But it is important for us to understand that we are not on the brink of something like a big recession or like a 2008. Nonetheless, I am a financial planner, which means that I am overseeing hundreds of millions of dollars, and I do look at all of these things on a regular basis to see if the current trends that we're seeing in the market are creating higher levels of risk, or we need to make larger changes in the portfolios. So we have made some changes already this year. We will continue to make those changes on a quarterly basis. And one of the things that I would ask of all of our clients is that as we send recommendations out to you, to please pay attention to them and get them back to us as quickly as possible, because they will be very timely. I've been saying for many years now that this is a strange time to manage money, and that statement just gets more and more accurate every single year. This is a very, very strange time to manage money. What we're seeing in 2016 so far is that there is not very much that's making money as of today. So even if we look across all of the market classes, what you're going to see in 2016, which we'll show you a little bit later, is that really the only thing that is making money consistently right now is fixed income. We do expect for that story to reverse a little bit later, but right now in 2016, we are having a difficult time seeing positive returns throughout the market. Let's go ahead and get started and look at where we were at least through the end of the year. So if you looked at your September statement versus your December 31 statement, you saw some pretty good results. This is the market summary for the fourth quarter of 2015. So as you see, the stock market was up pretty significantly. International and developed, emerging markets, and global real estate all showing positive performance. And the only downturn at that time was the U.S. bond market, losing about 0.5%. And a lot of that was in response to the Fed raising interest rates in December. The global bond market was slightly stronger than that, but really average return there was 0. If we look back at returns since January of 2001, so that's below the second gray line, the average quarterly return during that time period was 1.7% on the U.S. stock market. And you can see across the board that those numbers are all positive. It is important to note, though, that we are not in the same market environment today that we were in 2001 or 2005 or 2008 or 2011 or 2014. When the Fed stopped raising or stopped the quantitative easing program in 2014 and then began the increase of their rates in 2015, it set us into an entirely new market environment. And so the returns that we will see as most important going forward are the ones in our most recent history. So it is always important to take a look back at how, over the long period of time, how well portfolios can perform. It's also important for us as we are designing portfolio recommendations and allocations to realize that we are in a new world and we are not in the environment that we were while quantitative easing was going on in the global marketplace. So let's look at world stock market performance. This is for the fourth quarter of 2015. So we'll see another slide in just a minute that's going to show us the entire year and all the headlines that we saw. But I'm just going to walk through this a little bit and look at the big headlines that we had last year, and especially in the fourth quarter, and reflecting on those positive numbers that we just had. These were really, really negative headlines that we had. So a couple of things. The U.S. trade gap widened sharply on the strong dollar on the far left-hand side. The strong dollar was one of our biggest challenges in 2015. Thankfully, in 2016, the dollar is actually starting to weaken. And weaken is probably not exactly the right word. What we are really seeing is that it's not strengthening as much anymore. So it's not actually a weak dollar, but we just don't have quite the strength that we did. We're no longer going towards the super dollar status, which is where we were at the end of last year. A strong dollar is bad for our exports. It makes them more expensive, and it's also really bad for oil, as we've seen. And so if we see the dollar start to weaken somewhat, that's actually going to be a positive from where we are right now. The Iran nuclear deal was formally adopted, and we probably don't need to talk too much about that. What that has really done is it has allowed Iran to start producing oil again and to get paid well for it. So that is not helping the oil story, and the oil story is really what has unnerved our market more than anything, especially in the fourth quarter. Towards the middle, the U.S. inflation undershoots the Fed's 2% target for the 42nd month. Here's where I think that the Fed made a mistake. I think that the Fed really could have raised rates any time over the last year. They had some really key opportunistic times that they could have done it. They had some great times where the financial markets were really in support of an increase in the Fed interest rate. They chose not to do it. They declined the opportunity until December, and in my opinion, they really just shoehorned it in before the end of the year so that they could get it over and done with. It was not a good time to do it. The market had started showing signs of weakness, and they did not have a motivating reason from the point of view of inflation to actually raise the interest rate. So the inflation has been persistently under this 2% target. And the reason that the Fed should be raising interest rates is not because people want them to, but because they should be looking to curb an overheated economy. What we do not have right now is an overheated economy. So they did not have to raise the interest rates, but they did. It was widely expected that they would do it, and it has not changed very much as far as the lending rates. In fact, surprisingly, mortgage rates have gone down somewhat in 2016. But what it did do is it really told the stock market and the economy and everything that is influenced by the economy that the party is over. So the Fed is now going to be raising interest rates. There is a big topic of debate right now about how often they were going to be raising the rates and when they're going to raise them. Coming into January, we saw massive volatility in the stock markets around the world, and part of that was caused by China, and part of it was caused by concerns over the Fed raising the interest rates. The idea right now is that they're going to raise rates 2 to 4 times in 2016. I will be surprised if they even raise rates 1 time. I think that we'll get too close to the presidential election and they won't be able to raise after about June. And there's not a motivating reason right now with the higher levels of risk in the marketplace right now. There's not really a good reason for them to continue to raise. I will be surprised if we see the Fed raise interest rates before 2017. Nonetheless, my opinion is not the only opinion in the marketplace, and if the market thinks that they are going to raise rates 2 to 4 more times this year, that still provides a lot of uncertainty, and so that is one of the reasons that the market is really searching for direction right now. Next over, we're going to look at oil prices skid to 7-year lows, and so when we look at 7-year lows in oil, that is really not a good story. It's a particularly bad story for Texas, but it is a bad story really for the entire country, mainly because there is so much uncertainty around oil, and people in America like certainty around oil prices. This is a supply and demand story. There is an oversupply that is mainly caused by Saudi Arabia. Saudi Arabia made a really bad bet. They tried to play chicken with everybody else in the world, and that process has failed them. There is a strong feeling that geopolitical tensions will cause Saudi Arabia to join forces with some of the other big producers like Venezuela, Russia, and Nigeria, and to try to get those prices back down and for everybody to limit how much they are producing. At this point, though, that has not happened. And so anybody who says that they know when oil is going to come back up is just making up a date and crossing their fingers. We really need to wait for that to happen, but as soon as it does, we do believe that we're going to see the stock market start to stabilize. There's a strong feeling that if the oil prices are low, that is really good for other corporations that use energy quite a bit in their processes. We haven't quite seen the benefit of that yet, but it's possible that we'll see that in the next couple of quarters in the earnings session. So at the end of it, we see the worst year for the S&P and the Dow since 2008, and that's where the headlines started to scare people. That is a fact. It was the worst year for the S&P and the Dow since 2008, but for all of this weakness and what we saw in the whole year throughout the different headlines that we saw, what you're looking at right now is a slide that has the headlines for the entire year. We had some really bad headlines last year, and we had a whole lot of volatility. And in the end, the downturn was not too bad for 2015. What did happen, though, is that it created a hangover for us in 2016. You can see on the left-hand side of the screen at the top, NASDAQ Composite and S&P 500 to close at new highs. That happened in May of last year, and as you can see from the chart, we just have not recovered from that since then. Now, looking at the world asset classes and performance of world asset classes, the top performer was the Dow Jones Select REIT Index. So this is a commercial and residential REIT. REIT stands for Real Estate Investment Trust. That has performed the best in 2015, at least in the fourth quarter. So these are just the fourth quarter returns. As you can see, the S&P 500 index was close behind at 7%. And then we had the world outside of the USA small cap index. And you can see the performance of the other asset classes. At the very bottom, the bonds did not do well, as we talked about before. They lost a little bit of money, and then emerging markets were only down 1%. So all in all, despite all of those headlines, we still saw only a slight decline in emerging markets and positive returns elsewhere. As we go through this, I want to make sure that we have a really clear understanding of what we always say in our industry, which is that past performance is not a guarantee of future results. Also, for you to know, as we look at these index numbers, that the indices are not available for direct investment. The index performance does not reflect any expenses associated with the management of an actual portfolio. So these are index numbers, and these are not specific investments that we use in our firm or are available for direct investment. On the U.S. stocks then, looking at the fourth quarter, what we see is that we had a very interesting set of return numbers here. So if we look at the large cap growth number as 7.3%, large cap overall did 7.04%, and large cap value did 5.6%. Interestingly, and the reason I bring that up is that if we look at the period returns on the bottom right-hand side of the slide, If you look at the one-year returns going from top to bottom, market-wide, the one-year return was only 0.48%, and large cap value lost money to the tune of almost 4%, and large cap growth made money to the tune of almost 6%. And then you see that small cap value and growth both lost money. So again, strange times to be managing money. What we normally see is that stocks goes one direction and bonds go the other. For the last few years, we've seen them moving actually together, both in the same direction, which is not necessarily a healthy sign for the financial markets. We saw a lot of what we'll call dislocation last year, which means that we saw different parts of the market that we expected to be going in one direction and went completely a different direction. So it is highly unusual for us to see that large cap growth is so positive, upwards of almost 6%, and then large cap value would lose almost 4%. That is an extreme situation for us. And we did see also that bonds and stocks had a varying performance last year, and we've seen that carried through this year as well. On the bottom left-hand side, just so you get perspective of what we'll be looking at over the next 3 slides, the world market capitalization is represented by the entire circle. What we're looking at here right now is the U.S. market, which represents 53% of the entire world market capitalization. It's also important for you to keep that in mind as we go through conversations about China and the effect that China can have on the world as opposed to the effect that the U.S. can have on the world. So looking at international developed stocks are going to be Japan and Europe and those countries that we're used to. We saw another disparity on the bottom right-hand side in the period returns between the large cap and the small cap. So again, generally we see stocks generally move in one direction or another. They might all be positive or all be negative to varying degrees. And we really saw a lot of disjointed returns last year. The market outside the U.S. is in a very strange place right now. The European Union is being supported by a lot of quantitative easing that the central bank is doing over there, and we see the same thing in Japan. And so we are seeing returns that are positive enough for us to consider investing in. At the same time, we know that they're supported by central banks, and that's an area of focus for us as we look at how we are investing going forward. And again, looking at the chart on the bottom left-hand side, only 37% of the market is the international developed market. And then moving on to the last piece on the emerging markets. The emerging markets on the bottom right-hand side, if we look at the period returns, they have had a rough 1-year, 3-year, and 5-year cycle. It is only over 10 years that we see positive returns on the emerging markets. Emerging markets tend to make up a very small percentage of most portfolios. They don't tend to be an overweight in most globally diversified portfolios, and they're certainly not an overweight in ours. China is hitting the emerging markets pretty severely. So there are a lot of emerging market countries that are right around China, and they are very tight trade partners with them. And the other part that affects the emerging markets quite a bit is what happens with our Fed, which seems a little unusual. But if the Fed increases the interest rates, then the thought is over here that cash is going to get tighter, which means that Americans may not have as much money to spend, which means that the goods that the emerging markets export to us may not be purchased as readily. So when the Fed goes into a cycle where they are tightening, it tends to be a bad thing for emerging markets and their stocks. There are tons of wonderful opportunities in different emerging market companies, but they have to be very deeply researched. And so the emerging market stocks overall in the broad index have had a rough time, but there are really good opportunities in some of those emerging market countries. So looking at select country performance, then you can see that there have been some great returns in New Zealand. I'm not sure that there are really New Zealand-centric investments out there, but New Zealand and Belgium and some of these other countries had a good return in the fourth quarter. As I said, there's a lot of support right now from the EU to make sure that the EU keeps chugging along. They have a big problem right now with immigration. I think that they'll probably work through a lot of that, but there's certainly a lot of concern about what they're going to do with all of these people that have just been added to their population of late. And so there is some concern over all of the countries in the EU. You can see down there at the very bottom also that Canada had a fairly negative fourth quarter. It's fairly negative for Canada, and in general, that's a strongly negative GDP there. And what the problem is in Canada is mainly oil, and so they're not used to that kind of a return. So Canada, there's a little bit of concern about, but again, that's not a major area that we invest. On the emerging markets on the right-hand side, you'll see that Indonesia, Hungary, and Malaysia are going strong, and you might be surprised to find out that China is actually in the top 5 there. A lot of focus has been given to what's happening in the Shanghai index. That's really what gets reported most often. Just so everyone is aware, the Shanghai index is not something that anybody other than the Chinese can invest in. And so when the Shanghai index drops, the investments in America do not drop. Investors in America are not affected by it. But it still is important for us to understand the transition that's happening in China. So while they are still reporting very positive GDP, at least from Beijing, it is also important for us to know that a lot of people who are money managers and economists believe that the reported GDP is probably a ballooned number, and the actual GDP is probably closer to somewhere between 2 and 4%. China is a very large economy. We do need to pay attention to what China is doing and the effect that it can have on the rest of the market and the rest of the world. And we also have to understand that they are going through a time period right now where they are trying to make a transition from a manufacturing society into a consumer-based society, and that is a long transition. They are also trying to deal with communism and capitalism and how do they meld the two together so that they can make the most out of their population and out of their market, and how can they help their population the most as far as from a demographic perspective and an economic perspective. And that transition just is going to take some time, and it's going to happen in fits and starts. And so I don't think that China is something that we'll be able to take off the table in the near future, but I do think that it's important for us to continue to realize that the U.S. is very strong, our economy is very strong, and we remain the economic darling of the entire globe. I also wanted to make note of India. So India has made some changes recently, which has allowed their economy to have a whole lot more growth potential. And I think that what China may not be providing to the world economy as far as growth in the near future, I think that there's a whole lot of potential in India. And I know that in my industry, there's a whole lot of excitement about what India could provide to the global economy. So looking at REITs, we talked about REITs a little while ago and looking at what their returns were. So the fourth quarter returns in the REITs were 7.54%. Again, that is an index and not an actual investment. But if we look at the 1-year, 3-year, 5-year, and 10-year numbers on U.S. REITs, those numbers are consistently strong. The 10-year number, as you can tell, is going to include even the downturn in 2008, which was probably the worst thing that's ever happened to the real estate segment, and even after the recovery from that, we still see strong 10-year numbers, 5-year, 3-year, and 1-year. So we do have real estate in our portfolios, and we believe that that is an important segment that we continue to invest in going forward. Commodities are a different story altogether. So if we look at the period returns on the left-hand side for commodities in general, the fourth quarter was very ugly. A lot of that had to do with oil. The 1-year was very ugly. The 3-year at this point is very ugly. The 5-year at this point is very ugly, and the 10-year is not even positive. So commodities sometimes are seen as a diversifier in a global portfolio. We've never invested heavily in commodities. There have been times that we have put small portions of money in commodities, but this is not a main area of focus for our firm. And what you can see on the right-hand side is that commodities across the board had a very, very rough fourth quarter and last year. Commodities tend to be very up and down with their values. Not all commodities are a supply and demand story the way that oil is right now. A lot of it is affected by weather and populations and so on. And so this is not a main area for us to invest in. And now looking at fixed income. So fixed income has had quite a developing story over many years now. When the Fed decided to reduce their interest rates and go into the quantitative easing program, fixed income had a great time. Fixed income, for most people, we can just think of it as bonds. There are different kinds of investments also included in the fixed income area, but for the most part, what you can tell down here by the different indexes that are noted is that we're mainly talking about bonds. And bonds have done extremely well when the quantitative easing programs were going on. And then there was a lot of concern. We had the very same concern that when quantitative easing stopped, that it was going to be ugly for the bond market. And then, of course, when the Fed raised its interest rates, that was going to be ugly for the bond market. Not surprisingly, the bond market has actually responded well in 2016 because there has been so much risk in, or at least perceived risk in the stock market. So when the stock market gets very ugly as far as risk goes, generally people flood to the safety of bonds or the perceived safety of bonds. And in that case, we see the bonds start to make some money, and that's exactly what we have seen so far this year. So if we look at the one-year returns on the different indexes at the bottom of the page, the one-year returns at the end of 2015 were not that great. The high-yield index, you can see, is negative 4%. The reason that that corporate high-yield index had a bad year last year was because a lot of the oil companies have debt, and their debt is in the high-yield portion of the bond segment. And so we did see negative returns there. So if you're not invested in high-yield debt and you're in U.S. government bonds or high-grade corporate bonds, then last year tended to be either flat to slightly negative. If we look at the 3-year numbers, we see the same sort of returns, not that great, but positive, which is a good thing. If we look back at 5-year numbers, that's where we can include some of the work that was being done on the quantitative easing side, where we have some much stronger numbers. So what we expect for fixed income right now is that it will actually be steady to slightly positive. It is possible that if the Fed gets into a rapid increase cycle on the interest rates, that the fixed income will have some challenges, and it will be hard for it to hold its performance value. In the meantime, we believe that we are in a pretty steady place with the Fed, and that there's no reason to have concerns over fixed income. The other thing that I wanted to mention is that a lot of people have said, well, does stock market performance indicate that there's a recession coming? A lot of financial news has come out and said that when the stock market has a downturn, that you can bet that about 6 to 8 months from now we're going to see a recession. And there's an old joke that was made a long time ago in our industry that the stock market has predicted 9 of the last 5 recessions. And so the stock market is considered a leading indicator for a recession, but it only has about 50% accuracy rate. On the bond market, on the other hand, has a fairly accurate predictor of when a recession is coming, and that is when the bond yield curve is inverted. So the yield curve that you're looking at right now in the middle, the top middle of the page, that is a normal yield curve that we would see, and when that inverts, that is an indication that we are seeing a recession coming around the corner. We watch for that indicator very closely, and if we see something like that, we'll be making some significant shifts in the allocations of the portfolios. So what we've been talking about mostly up until now is the fourth quarter returns. And what I want to show you, since we are about a month and a half almost into 2016, is we want to show you where we are right now in the actual markets for 2016. So what we have here is, if you are looking at your portfolio percent, meaning that that part of the market is almost in bear market territory. The rest of it is what we call a correction. So a correction is a negative return of 10% to 20%. Corrections are extremely normal. When we get into bear market territory across more of the market segments, then we will look at whether this is something that's going to have another leg down or something that will extend further than we anticipate at this point right now. What I also wanted to call to your fortunate somewhat for the time period that we're in right now, where we have such a rapidly moving global market and we have information that runs from one market to another, is that we tend to see a contagion effect across stock markets. So Shanghai will open. Shanghai opens before I go to bed at night, so I always check what's happening over in the Asian markets, and we see what's happening there, knowing that that's going to have some effect on the European markets, which obviously open before our markets do, and then by the time that our markets open, it's going to be some sort of a reaction to what's happened in those other markets. So there is a bit of there's a bit of a contagion effect that does happen from one market to another, and as we see some of the markets firm up over the next few months for a number of different reasons, either from clarity from the Fed about what is going on there, or from oil prices getting stronger, then we will see that these markets continue to get stronger as well. The Fed is meeting, or Janet Yellen is giving her testimony today, and as I walked in, the markets were having a good reaction to that. So there's more testimony to come this week, and I don't want to call anything too early, but once we have an understanding of what the Fed is talking about going forward for at least for the next few quarters, and we'll see what the stock market reaction is to that. That may actually give us some positive momentum on the stock market as well. So another thing I wanted to have you all look at here is global diversification and what the returns have been. And so we absolutely follow a path of global diversification. We want all of our clients to have exposure to many different market segments, and we overweight or underweight different segments depending on their risk tolerance, on their time horizon, and what we believe is happening right now in the world and what is going to happen in the near future in the world. And so that is going to be some combination of fixed income and equities, international and domestic, small cap, mid cap, large cap, and then different sorts of bonds on the bond side. If you look at the period returns on the left-hand side, the bottom left-hand side, those are different asset class combinations. And again, these are all based on indexes and not on any particular investment. So you can see what the returns have been for 1 year, for 3 years, 5 years, and 10 years. Over the last year, the most positive return was 100% T-bills, 100% Treasury bills. It was a year to be safe and to not have a whole lot of risk as far as returns are concerned. But that story completely flipped over a 3-year, 5-year, and 10-year period. We really don't have any clients for 100% in stocks, but those portfolios have yielded the best returns over the 3, 5, and 10-year period. The problem with being invested 100% in stocks is that most people can't tolerate the volatility that goes along with it. So the 75-25 portfolios and the 50-50 portfolios, those returns are combinations of 75% equity, 25% fixed income, and then the 50-50 is split right down the middle, and 25% or 25-75 is 25% equity, 75% fixed income, and you can see how those have performed over time. While I do not enjoy going through a market environment like this, and neither do any of my clients, it is always a good time for us to check in and see where risk tolerance truly is. In fact, right before this phone call I got off, or right before this webinar, I got off a phone call with a client, and he has decided that he does not want to have as much risk in his portfolio anymore because of some things that are changing in his life, and so we're going to make changes throughout the year so that we get him to the allocation that's more appropriate for him now that he's had these changes in his life. It is okay to change your risk tolerance. What is not a good idea is when the market is in the downturn that it's in right now, where we expect it to have a recovery in fairly short order, to come out of the market and go to cash and sit on the sidelines, because that is how we tend to miss the updates of the market, since none of us will know exactly when that's going to happen. For our clients who have income coming out of their portfolios, we give them a whole lot of runway so that we don't have to liquidate when the markets are down. We are liquidating either out of cash or we're liquidating out of bond funds. And so we are very thoughtful about all of that and how it plays into the long-term performance of your portfolios. So as I said before, this is a strange time to manage money, but we continue to do it, and I imagine I'll be doing this for the rest of my life, as I've been doing it from the majority of my life already. So what do you do in a time like this that feels fairly uncertain? So first is remember your goals. Remember what the long-term goals are and what the short-term goals are, and if you think there are any changes on either one of those that we don't know about, we would love for you to tell us about them. We want you to stay educated. We are really committed this year to a very timely and frequent education process for our clients, not only about changes that are going on with things like Social Security and presidential elections and taxation, but also about what's going on in the market. So stay educated by people like us and hopefully not by the financial media. And like I said previously, when we send you recommendations for reallocation, we would love for you to return those to us as quickly as possible so that we can implement them in very short order, and communicate with us as often as you feel like you need to. So even if it's just for reassurance about what we're feeling or any changes that you have in your life, please contact us and let us know what's going on so that we can figure out how to help you the best. It is what our firm was based on. It is how I was raised. It is what our team is built for. And we are here to serve you and to help your family with your financial goals and what you're trying to achieve in your life. We thank you very much for joining us today. We thank you very much for being clients, and we look forward to talking to you soon. Have a great afternoon.